Welcome back to this week's market drama. Last week, the S&P 500 was up 1.5%. It's actually now up 11.5% for the quarter, despite the fact that for year to date is still down 14.5%. So why was the market up? Look, I wouldn't read too much into it. It was a quiet week when it comes to headlines because of the holiday. Nonetheless, the Federal Reserve's minutes were out. And what this basically is they take notes from prior meetings and then they release them later on. So they released them last week from the prior meeting. And there was some interesting commentary. A number of Fed committee members showed concern that if the Federal Reserve continues their aggressive hike pace, that they could put the financial system at risk. So this indicate that there's enough people within the committee that are saying, maybe we're going a little bit too fast, right? Another interesting line they included that had not been in the minutes prior was that they're expecting a recession as the base case. Just think about it, it's kind of crazy, right? So they're saying, yep, we expect the recession as the base case, but yeah, we'll continue hiking interest rates, right? So they're looking at a recession as a feature, not a bug this time around, right? In prior cycles, they were talking about how do we lower interest rates so we don't get a recession or we don't get a severe recession. So that's very different commentary that we had seen from notes. Switching gears to earnings. Earnings season is basically done for this past quarter. 97% of S&P 500 companies have reported. Where they're landing is 2% earnings growth year over year for the third quarter. Back in June, when they were forecasting third quarter numbers, they were looking more at 9% EPS growth. So clearly, as they got closer and they saw the data, we landed at a much worse than expected number. For the fourth quarter of this year, consensus estimates are negative 2%. This would be the lowest year-over-year quarter number that we would have seen since the third quarter of 2020 when COVID hit. So earnings are not looking great. For next year, the expectation is 5%. Usually, when you look at historical averages, they're more around the 7 or 8% growth over the last, call it 7 to 10 years. So why is this relevant? Earnings are the number one driver of market returns in the long run, right? When we look in the medium term, right, next year, even maybe the year after that, earnings don't look as there's not as many levers to pull for earnings to grow at the pace that they were before if the economy is decelerating and inflation is still elevated, right? Companies could pass on, some companies, right, especially in the consumer sector, could pass on some of that inflation cost to the consumer, but nonetheless, that could affect demand, right, if prices keep rising for the consumer. This week, November payroll numbers come out, as well as average hourly earnings on Friday. These are very important numbers as they give us a sense if we still have slack unemployment, right? The Fed's looking for more slack, I should say, rather than less slack of employment. And the average hourly earnings give us a sense of wage growth. Wage growth is something that had been low for decades, and then it's actually gone up a fair bit, and it's very sticky. It's hard to bring down. You need to bring back down wage growth if you want to see inflation, core inflation especially, come back to the levels that the Fed wants, right, in the 2 or 3%. So that's what to look for this week. Stay tuned for next week.